On behalf of CCPA, I would like to extend our heartfelt wishes that everyone is healthy and that you have the support you need to endure this trying time. Please don't hesitate to reach out to us if we can assist in any way. We are all navigating this unknown territory, and we are here to provide support and connect people as we all figure out how to help Philadelphia's business community overcome the many challenges that lie ahead. We will continue to shift our programming and networking offerings to best support our members and guests. And we want to hear from you, so please use the chat feature throughout the program to send suggestions. Let's review a few details about today's event. We are recording this so we can share it afterwards. You are encouraged to use the chat feature to ask questions, which we will answer at the end. Feel free to comment, make suggestions, and connect with each other. We will mute everyone to maintain audio and visual controls, but may invite you to unmute at certain times. As a reminder, you are live on video. If you need to take care of business, feel free to turn off your video. CCPA is an intimate and diverse group of business owners, executives, and managers looking to build relationships and offer each other meaningful resources. That hasn't changed. We will continue to bring you unparalleled access to speakers, decision makers, and leaders who are shaping Center City. We will continue to keep our members and guests informed about business challenges and opportunities in Philadelphia and help them become Center City smart. Now I'll mention a few of our upcoming events. These continue to be all virtual. Our next Lunch with City Leaders is July 29th with Lauren Gilchrist, the Senior Vice President and Senior Director of Research at JLL Philadelphia. We have started a new series called The State of Hospitality, which starts on July 23rd with a discussion about restaurants. And the second panel is August 4th about the hotel industry. And you can find a full schedule of our events on centercityproprietors.org. I would like to acknowledge CCPA sustaining sponsors, our preferred benefits provider, Michael Craig of Penworth Financial Services, and WeWork, the home of our headquarters. Lunch with City Leaders is made possible by Citizens Bank and our sponsors, the Community College of Philadelphia, Friedman LLP, KYW News Radio, Lev Lane, Post Brothers, and Visit Philadelphia. I would now like to welcome Dan Fitzpatrick, the President of Citizens Bank Mid-Atlantic Region, to say a few words.
Suzanne, I'm going to pass it to David Yagroff to do a quick opening. I'll do a wrap up.
Okay, great. So now I'd like to introduce David Yagroff, the Senior Vice President and Market Manager from Entercom Philadelphia.
Thanks so much, Suzette. Great to be here today. KYW News Radio has been serving the Philadelphia region with essential, agenda-setting, community-focused news 24 hours a day, 7 days a week since 1965. With one of America's largest and most experienced teams of multimedia journalists, KYW delivers breaking news, compelling features, a variety of original podcasts, up-to-the-minute traffic, and more to hundreds of thousands of listeners every single week. You can tune in at 1060 a.m. or at kywnewsradio.com or on the radio.com app on your smartphone, or by asking your smart speaker to play KYW News Radio. Our new corporate parent, Entercom, recently relocated all of our stations and our corporate team into one state-of-the-art facility at 2400 Market Street, and we are proud to be part of Center City and delighted to be part of this series. Today, I have the honor of introducing our speaker. Patrick Harker took office in 2015 as the 11th President and Chief Executive Officer of the Federal Reserve Bank of Philadelphia. In this role, he participates on the Federal Open Market Committee, which formulates the nation's monetary policy. Previously, Patrick was the 26th president of the University of Delaware, and he was also a professor of business administration at the university's Alfred Lerner College of Business and Economics, and a professor of civil and environmental engineering at the College of Engineering. Patrick was dean and Reliance Professor of Management and Private Enterprise at Wharton, and prior to that, he was the Wharton School's interim dean and deputy dean, as well as the chair of their Operation and Information Management Department. He's published and edited 9 books and more than 100 professional articles, and he has served as the editor-in-chief of the journal Operations Research. In 2012, he was named a fellow of the Institute for Operations Research and Management Sciences and a charter fellow of the National Academy of Inventors. He was also named a White House Fellow by President George H.W. Bush in '91 and a special assistant to FBI Director Sessions from 91 to 92. His full bio is the program that was sent to you earlier, but here he is to tell us the full story in person. So please join me in a warm virtual welcome for Patrick Harker.
Thank you, David, so much. And thanks everyone for having me here. It is really great. I wish we were together, but it's really great that we can get together virtually. And again, I want to thank you for taking the time to be here. So given that today's lunch is virtual, I won't do the standard thing and urge you to start with your salad and then at the end tip the waiters. But I do have to do another standard thing and give the standard Fed disclaimer. So the views I express today are mine alone and do not necessarily reflect those of anyone else at the Federal Reserve System or on the Federal Open Market Committee. You are my witnesses. I can't get in trouble now. So we're about 4 months into the coronavirus crisis and the onset of what I do not want to call the new normal. None of this, including the fact that we're meeting here virtually today, is normal. Over that period, we went from enjoying strong economic growth, stable prices, and near record low unemployment to sharp contraction of economic activity, tens of millions of job losses. Meanwhile, more than 130,000 of our fellow citizens across the country have lost their lives to COVID-19. And the number, unfortunately, continues to rise every day. It has simply been a heartbreaking period. Now, I was trained as an engineer right here in Philadelphia at Penn, and one of my guiding principles has always been to trust the science. We're relearning that lesson anew during this period. Despite enormous sacrifices made by tens of millions of Americans, the country has still failed to control this virus. That is first and foremost a public health crisis, and it's an economic one as well. Now, a Fed president might like to think otherwise, but there is only so much policymakers can do right now to affect the economy. Our country's economic performance in large part depends on what happens with COVID-19. The projections I'm about to share with you, in other words, come with a huge caveat. They're constantly changing along with the path of the virus. Still, doing a bit of averaging, I can tell you that forecasts are suggesting about negative 20% GDP growth in the first half of this year, followed by 13% growth in the second half. 2020 growth would end up around minus 6 or 7% for the year. That's a much sharper recession than we experienced during the financial crisis. None of this is to suggest that policymakers sit on their hands until the virus passes, of course. We just simply can't do that. Indeed, the pandemic has brought forth a policy response, I believe, commensurate to its gravity. Congress provided significant fiscal support for the economy, which has blunted the pain of the contraction. And the Federal Reserve's role in mitigating this crisis has been to use our lending powers to maintain our underlying economic infrastructure by making sure that every sector of the economy, to the extent we can, has access to liquidity. Our lending facilities, this is important to emphasize, our lending facilities are meant as backstops to the private sector. We don't want to disintermediate the private sector. We simply want to be there to support market functioning. We've done this first and foremost by lowering our policy interest rate to near zero, fast and early. We kept this stance unchanged at last month's FOMC meeting. As shown by the Survey of Economic Projections, also known as the dot plot by the media, almost all my colleagues believe, as do I, that it will be appropriate to maintain the policy rate near zero if the economy evolves as expected. Using the discount window, we are also actively encouraging banks to borrow money from the Fed at ultra low interest rates in order to make sure that they have the funds they need to serve their customers at this critical time. In order to keep markets functioning, beginning in March, we started buying large amounts of Treasury bonds and mortgage-backed securities. We have now purchased more than $2 trillion of these products. The markets have largely stabilized, and we've slowed the rate of purchases, but we are not stopping. We intend to keep buying about $120 billion worth of Treasury bonds and MBS each month. As a backstop, We've also purchased some corporate debt. And as the economy and credit markets heal, we will disengage from that market as prudently and expeditiously as possible. Backed by credit protection from the US Treasury, we've also launched the Main Street Lending Program, which provides support for small and mid-sized businesses that were in good financial standing before COVID-19. The program just opened. It opened in June and offers a variety of 5-year loans to US companies employing up to 15,000 workers or revenues of less than $5 billion, while deferring principal payments for 2 years and interest payments for 1 year. In conjunction with the Treasury, we are also considering ways to broaden the program to include nonprofits. And I, in particular, think this is a very important move given, say, Philadelphia with the eds and meds, making sure that those nonprofits that play such a crucial role in our communities can get through this period. There's been somewhat limited interest in Main Street. Only about 400 banks have registered to participate in the program. But in a way, that's actually a good sign for the economy because it means that firms have access to capital without having to use the Fed. Because recall, in all of this, we are simply a backstop. On the other hand, if there is another major downturn in the economy, these facilities will still be in place to offer funding. At the same time, we're bolstering the heavily utilized Small Business Administration's Paycheck Protection Program by supplying liquidity to financial institutions that are issuing loans to those businesses that are receiving aid through the program. There's been, as you know, a lot of interest in PPP, with more than 4.5 million loans issued to the tune of more than $520 billion. We've also rolled out a program to help cash-strapped local governments. The Municipal Liquidity Facility, whereby we buy bonds from municipalities and states whose tax revenues, as you know, have collapsed, is designed to provide essential liquidity as they navigate the twin crises of the pandemic and the economic downturn. The state of Illinois has already tapped this, and we're also opening up to multi-state agencies like the Port Authority of New York and other transit agencies. We will recover. We will recover from this period, and there are already small signs that a rebound is underway. But I think we all know it's going to take time. As the recovery takes shape, I want to make sure that the coming growth is not only strong, but inclusive. It's worth noting that even though we went into the COVID-19 crisis with a very strong economy, far too many Americans, disproportionately Americans of color, were not sharing in that prosperity. So I, along with some of you, I know Dan Fitzpatrick is on this and many others, we're serving on the Greater Philadelphia Chamber of Commerce's Regional Recharge and Recovery Task Force. Our goal there is to make sure that the recovery from the COVID-19 crisis is not only stronger in terms of growth, but also includes more of our fellow citizens. The next period of growth should be strong and more inclusive than the last. So that's a tall order. How do we do that? Our work could include doing things like improving small businesses and especially microenterprises access to capital, to credit. I don't need to tell you that small businesses are the lifeblood of our communities. In this city, the city of Philadelphia, fully 99.5% of businesses, 99.5% of businesses have fewer than 500 workers. And of those, 54% employ fewer than 5 people. These are those microenterprises. Many of these microenterprises don't have the benefit of established banking relationships. Frankly, some of them have never banked at all. That leaves them at a huge disadvantage, as we saw when many were unable to obtain PPP loans. And this is a problem that has disproportionately affected racial minorities and communities of color. Now, to be sure, there are many historical and structural reasons why so many of our microenterprises remain unbanked. But that doesn't mean that this is a status quo we have to accept. As we work towards recovery, we should be thinking about how to tear down the impediments to those microenterprises having access to the banking system. Creating economic and professional mobility is also going to be key in making sure all segments of the country benefit from the recovery that is coming. It will come. So last month, for example, the Philadelphia Fed released a paper that I think provides an encouraging roadmap for how that might take place. And I want to share a couple of the findings with you. So Fed researchers looked at the skill sets of people in 33 metro areas across the country, including Philadelphia, who are holding those jobs that are most at risk of disappearing in this crisis. They then match those skills to jobs that would pay at least 10% more than their current wage and that do not require a 4-year college degree. The bottom line of this work is this: we don't have to accept that those in at-risk, low-wage jobs will remain so forever. The researchers found that nearly half of lower wage employment can be paired with at least one higher paying occupation requiring similar skills. And the pay differences are really significant, with an average bump in wages of almost $15,000, a 49% increase in salary for transitions connected with the most similar occupations identified in the study. Transitioning people into the right new job can honestly be the difference between a life of poverty and the life of a solid middle-class standard of living. The possibilities for creative public-private partnerships are very encouraging and exciting. Transitioning low-wage workers into higher-paying jobs not only helps companies themselves insofar as they are tapping underutilized human capital, but it also helps redress structural inequities. Communities of color stand to benefit because they have for far too long and far too often been shut out of higher wage work. At the Philadelphia Fed, we've helped launch such a program, such a public-private partnership, working in partnership with Comcast and Philadelphia Works, our local workforce investment board. Philadelphia Works provides upfront investment in a pilot job training program for Comcast. Comcast then pays for outcomes once they are achieved, such as staying on the job for at least 6 months. It's a tremendous example of what thoughtful public-private partnerships can accomplish. Now, we simply can't push all of this on the public sector, especially now. They don't have the bandwidth or the money, but intelligent public-private partnerships could be a very promising way forward. So rather than staying stuck in this new normal or moving back to the old normal, I'm very confident that we can together forge a better future, a better normal perhaps, for all of us. So let me stop there and open it up for any questions.
Okay, terrific. I'll start with questions that have come into the chat. The first one you may have touched on, but maybe you can elaborate. Has there been good usage of the PPLFs or the PP loans by the banks?
Yeah, so again, let me give a little context for those that are not completely familiar with the PPP. The PPP program is a small business administration program. We at the Fed, through our PPP lending facility, liquidity facility, are trying to put more liquidity into the banking sector by taking some of those loans off the bank's books. There's been obviously a lot of demand. And in fact, I think that could be expanded given where we are right now with the path of this virus. I mean, the virus is not going away quickly. And in particular, this recent surge that we're seeing is very troubling, obviously, first and foremost, to people's health, but also for the economy. So I think the expansion of programs like PPP makes sense. But again, what I said in the earlier comments, we need to make sure, though, that the people who didn't have that, it made sense for banks to work with their existing clients. I'm not criticizing that. But there were a lot of people shut out of that. A lot of micro enterprises in particular shut out of that. And that's something we're going to have to work on going forward.
Okay, as you know, wealth in the African American communities continues at best to stagnate. The loss after the Great Recession impacted communities of color the greatest. How will this pandemic affect African American communities, and what does the Fed believe we need to do in the short term and the long term? Yeah,
so in the short run, we need to stem the damage. We need to try to stop some of the real damage that's occurring. I'll give you one example. So there's a recent paper from the National Bureau of Economic Research and looked at Black-owned micro enterprises, Black-owned small businesses. Their estimate is 41% have already gone under in this crisis. I mean, this is not only devastating to that business, but to the communities and to the people, even if it's a handful of people, there are people who have a job with those companies, those micro enterprises. So that, I think, first and foremost in the short run is, again, trying to extend liquidity or do what we can do. And we're limited in this. This is more on the fiscal side of the house with Congress and the administration to create a lifeline to those small businesses so that they can function. In the longer term, issues of access to banking, to credit, to technical advice for those small businesses, because what a bank provides to a business is not just capital, right? They provide technical advice. They know-how to that small business. So making sure that those small businesses, particularly those minority-owned small businesses, have access to that know-how and to capital remains important. Same time, on the individual's point of view, we need to really double down, as I said, on workforce development programs. There are pathways to the middle class. This is what we've been documenting through our work. We have a program at the Philly Fed called the Economic Growth and Mobility Project, where we've been working now for several years on really a three-legged stool. Creating jobs, what we call opportunity occupations, that pay above median wages. That is, put people into the middle class. Creating the skill sets for those people to have those jobs. And then last, the part that often gets overlooked is what I'll broadly define in quotes, infrastructure. If people can't get to a job because they don't have a car or there's no transit, or the job can't get to them because they don't have broadband access, they don't have a job. And layer on to that, childcare and other issues. I mean, those things are necessary for somebody to be able to not just get the training, but get employed. So we've been working on this pretty aggressively for the last couple of years, and we will continue to do so.
Okay, as we go through these questions, I'll ask forgiveness if I read one and it's something you just spoke about while I was reading the questions.
That's okay.
But which macroeconomic variables do you believe will best show the speed of recovery from COVID?
I think unemployment data, both not just the headline unemployment number, but we look at a whole host of employment data to really see people getting back to work. It's going to be a slow recovery. I mean, our estimate is people talk a lot about whether it's going to be a V, a U, a W. I actually like the swoosh, the Nike swoosh model. It's going to be sharp down and it's going to recover. But it's not going to recover in a straight line, in a swoosh. It's going to bounce around. What we're seeing right now is things will open, they'll close, until we get this virus under control. First and foremost, what's going to drive economic outcomes, even before the macroeconomic variables, is what happens with the virus, right? So the epidemiology. That is what we're really paying a lot of attention to. Because if people, I mean, 70% of the US economy is consumer spending, 70%. If people don't feel confident, they can walk into that restaurant, that bar, that retail establishment, get on a plane, stay in a hotel. No matter what happens, if they're not trusting that they and their families are safe, they're not going to do it. So we need to contain and control this virus first and foremost until we will get back to where we want to be as an economy.
Are we able to assess the impact of the lack of national response to contain COVID-19?
Again, I think we're seeing this in some of the employment data, the output data that we're seeing across the country, particularly in the service sector. I mean, this is where it's really hit hard, right? Travel, tourism, hospitality, a host of industries like this. So yeah, we're monitoring all that data very carefully.
What is your and the Fed's feeling on levels of US debt? And how would you categorize the health of the US economy relative to our global peers?
So I can just speak for myself again. I'll give the disclaimer. I can't talk for the Fed, but for me, what we had to do when the crisis hit, we learned our lesson from the financial crisis. That is and the lesson was, when you have a major shock to the economy, and this is a big one, an unprecedented one, you have to act decisively and quickly to stem the damage, the bleeding. We did that. We took rates down to zero almost immediately. We started providing liquidity to get markets functioning again, starting with the Treasury and MBS markets, because they are the cornerstone of the markets. If they're not functioning, other markets won't function. So we did what we had to do, and I am fully supportive of what we had to do. That said, God willing, as we recover sooner rather than later, we need to start pulling back on that. We shouldn't just let this linger forever. We need to stay where we are now until we see real recovery of the economy, not just hints of it. But at that point, the facilities we put in place, the lending and the support to the economy, we need to start pulling back over time as the economy starts to grow again. So it's going to take some time. Overall, I think the broader issue in the long term, which I've spoken about a lot, I am worried about the overall level of debt, not just at the federal level, but at the state and local level, and there's even some concern of the corporate debt levels that we're seeing in certain sectors of the economy. So that is a longer term issue. I do think that puts us, if we don't collectively try to solve that problem, at a competitive disadvantage in the world. But I'm confident, I'm an optimist, I'm confident we can address that.
Can you elaborate on the utilization of the PPPs as means to recovery?
So again, its initial goal as structured by Congress was to keep people on the payrolls, right? So that they had the support they need and to literally keep the lights on in these businesses and the heat on or the air conditioning. So that was the goal. And I think without PPP, we'd have much more severe economic damage. A little too early to tell, to do the exact analysis of that, but people are working on this, economists are working on this. But it's clear that this was something that was very, very effective early on. That said, I think there's still some issues because in particular regions of the country and in particular sectors of the economy, these businesses may not open fully. And we're seeing this, right, with the stops and starts with things like restaurants and so forth. So continue to try to provide support to keep those firms going and the economic infrastructure going, I think is really important.
How do we address?
By the way, I'll say, start eating your dessert. So.
How do we address the micro enterprises and their need for money to get them through this period? Could we get them connected to the banks and use transition funds as a way of building a bridge?
Yes, I think there's two things. One is directly to the banks, but there's another important set of institutions in the country, CDFIs, community deposit financial institutions, right? Depository financial institutions. These CDFIs really are on the ground working with these communities each and every day. And so banks know these CDFIs. And so it's not just the banks alone, but it's the banks in conjunction with CDFIs and I would say other nonprofits in the region who are committed to keeping those businesses and their communities alive. So for all the small businesses that don't know about the CDFI in their region, I'd encourage them to reach out. We can help that. I mean, if you just contact the Fed, we can help you connect.
Do you believe it makes sense to continue paying banks interest on their reserves if this deters them from making more loans?
Well, at this point, it's not deterring them from making more loans. If you look at the banking industry as a whole, most banks have ample liquidity. Part of it is we're not spending the money, so it's sitting in the bank. We saw that particularly with the stimulus payments that came in. So in the short run, that's not an issue. The banks, we pay the interest for two reasons. One is pretty technical when it comes to monetary policy. The other is more pragmatic. They have other options where to put their money, especially on excess reserves, reserves above the legal minimum. And for a lot of reasons, reserves are they are the safest form of investment for the banks. And we want the banks to make safe investments, right? It's really important for them. And we even coded that into regulation. On a very technical issue, which I won't get into a lot of detail unless you want to, excess interest on excess reserves is actually one of the main monetary policy tools that allows us to control interest rates. Without that, we have a hard time controlling interest rates. The main goal of monetary policy is we don't have the Fed funds rate is a market rate. It's a traded rate. We don't have direct control over that other than going into the market and trading. We do have for administered rate, this excess reserves that actually allows us to control interest rates. And that's one of the primary goals of monetary policy. It's not just setting the interest rate, but making sure that actually happens in the markets.
Can you talk more about the programs that target specific industries that are more impacted? Restaurants, childcare centers, entertainment venues.
Yeah, so these are outside our realm. These would be more in the fiscal side of the house. And again, this was where PPP was designed to help those institutions and also some nonprofits. Our facility is really, again, not directly involved in that. We're not making those loans directly.
Okay, often small businesses struggle with the skill set, or what we refer to in 10,000 Small Businesses as the toolbox. What, if any, plans are there to fund programs that will give small businesses, particularly minority businesses, the skill set to restart their businesses or launch new businesses?
Yeah, I think that's a critical area. And this, as part of this recharge and recovery effort for the Greater Philadelphia Chamber, this is one area that I know will rise to the top. Again, there are programs to give them skills. There are a lot of small business centers, like Wharton has one and others have one. But we also, the banks themselves have that expertise to help these small businesses. But if they don't have the banking relationship, they're not going to get that technical advice.
I don't think we've ever had so many questions. What impact does the result of the election have on the recovery and the pandemic? If you can comment.
You mean the upcoming recovery? I mean, the upcoming election? Yeah.
Yeah,
so,
the result, either way, I guess, how it would affect it.
So we obviously stay out of politics. The Fed is squeaky clean apolitical. We try to do what we need to do. So I won't comment on the election overall, other than to say this recovery is going to take time. Our best estimate right now, before the surge that we're seeing in the South and Southwest hit us, was that we wouldn't get back to close to where we were before until the end of 2021. It's going to be this is the swoosh, it's going to be a long recovery. That all depends on the fiscal side of the house and kind of stimulus that they will or will not provide. So I think that is at stake in the election, because that'll change depending on who's in office, not just in the administration, but also in Congress.
Have you noticed a difference in the frequency or intensity of communication with your peers through this period? And do you expect any of these shifts to be sustained?
You mean my peers, my other fellow Fed presidents, I guess? Yeah, and the Board of Governors? Yes. So when the crisis hit, we were communicating constantly, including having extraordinary meetings of the Federal Open Market Committee. We had one on a Sunday. And we continue this. Now, just so you know, a little bit of sausage of the Fed. It's an unusual institution in that Jerome Powell, is chair of the Board of Governors, is also chair of the Federal Open Market Committee, on which I serve. I don't report to Jay Powell, though, as president of an independent reserve bank. I report to an independent board of directors of the Philadelphia Fed. We are obviously related to the Board of Governors, who are presidentially appointed, Senate confirmed. But as a result, the banking side of the Fed, which people often don't think about, we are a bank. We are a bank to the US government. We're the fiscal agent for the Treasury, and we're a bank to banks. We provide, our IT group is large. We provide lots of what we call the rails of the payment system throughout America. We're moving the money across the system. That is run basically as a collective. We, the 12 presidents, and my first vice president, the chief operating officers, we run this as a collective. So we spend lots of time together, is my point. This is not one where we don't know each other well. We know each other extremely well. We really work as a collaborative.
Is it healthy for the U.S. economy to be 70% consumer spending? Does the U.S. need to do more to diversify its economy from dependence on consumer spending? And where should that effort be focused? What's the healthy mix?
Yeah, so all advanced economies have moved in that direction for a very simple reason: productivity growth. And so I am supportive of the idea of onshoring more of our supply chains, particularly for those critical goods that we need. That said, it still won't move the needle in a major way when it comes to that number, for a very simple reason. Manufacturing is highly productive generally, as opposed to more person-to-person service-based industries. I mean, it's hard to get rid of a lot of people in those industries, and nor should we. So that number is pretty much what all advanced economies are at this point. China is not there, but it's moving pretty rapidly toward that. And it's just simply a function of the productivity of other sectors of the economy. I mean, take the extreme example of this, if you don't quite believe me. Less than 5% of the American workforce in any way, shape, or form works in agriculture. Less than 5%, well less. And that includes everything you could wrap around agriculture. Why? The intense growth of productivity in that sector. And so, could we bring back more jobs in agriculture? We could move the needle a little bit, but not on a massive scale, because it's just the productivity of the sector.
Should we be prepared for tax increases no matter the result of the election?
Yeah, so that's not up to me. That's above my pay grade. And this is one that is really in the hands of the administration and local, state legislators and municipalities.
Okay, as you mentioned, the pandemic has had a substantial impact on the tourism and hospitality industry.
Yeah.
Do you believe there are federal or local financial policies or incentives to spur consumer spending?
At this point, I don't believe that consumers are not spending because of the money, although I think that will, if unemployment continues to be at 10+%, which we're estimating by year end, we'll still have an unemployment rate around 10% or maybe higher given the surge that we're seeing. So, but I don't believe consumers right now are not spending in those sectors because of money. It's because of safety, whether it's government mandate to shut down, or they just simply feel unsafe to go into those establishments yet. That's human nature. I mean, people, if they don't feel safe in those environments, they're not going to go no matter what kind of financial stimulus we would give them.
Okay, a couple more. As a former higher education leader, what are your thoughts on the impact to higher education? What about the impact that these institutions have on their college towns?
Yeah, it's an incredibly important issue, and one that not only the education institutions, but also medical institutions. I'll start with medicine because it's, in some ways, both are bad, but you think about medical institutions, and some of those are related, like in the city of Philadelphia, to universities, but not all. We saw before we went into this crisis, rural medical centers were already struggling, and this is just making the situation worse because all the elective procedures have essentially stopped. They're starting to come back slowly, but it's going to take some time. The eds, there were already challenges in higher education because of demographics. This is really important for the Philadelphia region. People don't often recognize this, but the Philadelphia region has over 100 colleges and universities. I mean, it's a very large sector of our economy. And they, because of demographic shifts, were already struggling. That is, the college age population was in decline. The traditional college age population was in decline, just demographically, and also diversifying very rapidly. And so institutions were trying to figure out how to meet that need. In some cases, it was with international students. There were other approaches that people took. This has just accelerated this trend of pressure on higher ed. And so I feel from my former colleagues in the higher ed space, because higher ed is the pathway to the middle class, not just for four-year institutions, but associate programs like the Community College of Philadelphia and certificate programs. These are all the ways that people can make it into the middle class. We have to try to preserve that infrastructure.
In the example of agriculture, what are other industries that you think will see large decrease in total workforce?
So I think, again, we're not so much in manufacturing. We've seen, and it'll continue to be productivity growth, but we're starting to see in certain sectors, including retail, obviously a big shift, which is again accelerated in this crisis. We're moving from the retail clerk in the local store to in a fulfillment center at a major online retailer. I think that trend is going to continue. And what's problematic about that with respect to particularly low-income communities is a lot of those jobs aren't in the city center or easy to get to by transit. So for example, I mentioned the Economic Growth and Mobility Project. Our first project was Northeast PA, where we work with the Scranton, Wilkes-Barre, Hazleton area. Because what was happening is there were fulfillment jobs out on the highways, truck repair jobs, lots of good paying jobs, particularly the truck repair jobs. But the low income people sitting in the city of Scranton didn't have a car, so they couldn't get there by transit, or they couldn't get there in second and third shift. A collection of organizations came together, nonprofits, companies, transit agencies across that region. And they now have an organization called NEPA Moves, Northeast PA Moves, where they're trying to solve that problem. So as these shifts occur, not just in terms of the skill set of workers, but where those jobs are, this is where this infrastructure part of our three-legged stool becomes even more important.
I think this may be the last one for now. Do you think there's a fiscal policy recommendation that we should implement that is not being considered?
So I think a lot of things are being considered, so I wouldn't say that things aren't being considered. For me, and I'll only speak for me, there are lots of potential expansions on the fiscal side that make sense. But I'll just mention three. I think three are really important. One is with unemployment insurance about to run off, there's what economists call a cliff effect, right? So people are getting this payment and then boom, they're not getting this payment. That is not only bad for that individual, but it's bad for the economy, given that 70% of the economy is consumer spending. If people suddenly don't have that money in their pocket, we're going to see continued decline of the economy. So some expansion of unemployment insurance makes sense to me. I get that maybe it's not at the level it currently is, that we might want to ramp that down now. That makes sense to me. So to give people incentive to maybe change and go look for a different kind of work, but not just to cut them off. Second, state and local governments. We talk a lot about anchor institutions, particularly in the Philadelphia region, the EDs and MEDs, but state and local governments are anchor institutions. They're big employers. If, because of the decline in tax revenue, they need to start laying off large numbers of people, that's going to be problematic for the economy as well. So some support to state and local governments. And then third is what we've been talking about earlier, some expansion to small businesses, particularly micro enterprises, new ways of thinking about how to get money to them so that they can survive this crisis.
What kind of infrastructure supports should we be pursuing? Are there any innovative ideas in this space?
Oh yeah, there's plenty. I mean, but some of it, but it all comes down to is instead of this one size fits all, I go back to just the example of NEPA Moves up in Northeast PA. They're using existing infrastructure, but in a different way to solve the problem they had. So but what works there, and we've had other cities approach us about using a similar model, but it's not going to work everywhere. It's not going to work in the city of Philadelphia, for example, in the same way. So it really needs to be tailored to the community. And what we learned out of that, I think the important lesson we learned out of that, we partnered with Wilkes University in the region, where we really tried to build the skill set there. So they own this issue, and they're doing a terrific job of owning this issue. It's about bringing the community together. There are tools that you can use to bring the community together in a structured way to help address whatever the infrastructure is. For there, it's transit. You go up to Wellsboro, PA, in the northern tier of the state, half the county doesn't have broadband access, has no internet access, and very limited cell phone access. So their problem is very different. So I think the answer is community by community.
That's the questions in the chat. We have a few more minutes if anybody would like to, one at a time, unmute or post another question. And David Lane, did you have a question?
I didn't. I think it was really answered, but I'm really interested more in how the Philadelphia Fed, the partnerships that you have, like the one you just mentioned up in the northeast part of Pennsylvania. How does the Fed work with these? Who are these groups, and how do you get involved? And what's your get it going, and how's that work? I'm interested in hearing more about that, if you could.
Yeah, good. So every one of the 12 reserve banks has a community development operation, and we have what's called a community affairs officer. This really grows out of the 1970s Community Reinvestment Act, where we got involved in research because banks were required to make investments into their communities. The obvious question is, what are the most effective investments we could make? Fed researchers took that on over the decades to really build a deep body of knowledge around what works for communities, what really moves the needle on economic development, particularly in low, and our charge is really low, moderate income communities. So each one of the 12 banks will do something very different. We won't do exactly the same thing. For example, Minneapolis has a whole center and outreach to Native communities because they have issues. We don't have so much that issue here in the 3rd district, the Philadelphia district. So we have built a pretty strong bench over decades around low-income communities, particularly in like our region of old industrial cities, Reading, Scranton, who haven't quite made the turn to a different economy. And we host a major conference, which we're unable to do physically this year, called Reinventing Our Community. So I'd encourage people who are interested to look for that. This is a major conference of 500 plus people, policymakers, community people, philanthropies, all focused on getting their hands dirty, rolling up their sleeves on how do we move the needle on our communities with the issues we face. So we doubled down on that when we created this Economic Growth and Mobility Project. And so if you're interested, please let me know and I'll put you in touch with the team there. It's an excellent team. They're very engaged. Right now, we're doing even more work here in Philadelphia as part of this effort to try to figure out how to get out of this crisis better than we came in, both in terms of growth and inclusivity. So yeah, just let me know.
Anyone else?
Hi, Pat. Yes. Hi, Pat. Charmaine.
Hey, Charmaine.
How you doing? We have been doing some work, and your team has been doing a great job of working with us. We have a group of people who come together, which include the banks, include community development organizations, and government, to really figure out how we can do a better job of investing in low-income families and communities. And certainly you've talked about how do we improve incomes, but we also know that we're continuing to look at this issue around home ownership and credit scores, and what does that really mean, and how can we move the needle on home ownership in a way that doesn't go back to the bad old days of adjustable rate mortgages and that kind of thing, but that doesn't sort of keep lower income workers out of the wealth building side on the home ownership side.
Yeah, no, I know of this work and I applaud this work. This is really important because, as you all know, for the vast majority of Americans, their wealth is really their house. I mean, that's where they accumulate wealth. So if you never get into the game of owning a home, you're never going to be able to get on the wealth accumulation ladder for not just your generation, but for your future. So this is really important work, Charmaine.
Thank you.
Any other questions? Dan, did you want to comment or?
I had a question.
Allison?
I'm not sure if I'm supposed to ask questions, so.
We have one from Allison.
Hi, thanks. Patrick, I was hoping you could just talk a little bit more about the numbers you mentioned at the top of your call about GDP growth being negative 20% in the coming 6 months and
No, in the first half of the year.
Okay.
So think about the hit we took in the first half, and then 13% in the second half of the year. But that was prior to the surge that we're seeing right now.
So I know you mentioned that that's sort of a caveat to all of these figures. Is there a way for you to give us some type of estimate for the coming 6 months?
Yeah. So our estimate was 20% hit in the first half of the year. And then we start to do the swoosh, start to climb out of this and see about a 13% increase in GDP in the second half, which would net out to roughly, think of it as 7-8% overall decline for the year 2020. Big caveat though, that was before we saw this surge. The surge will clearly slow the economy down because of consumer spending being slowed down. Exactly how much, we're still working on those numbers because this is continuing to unfold. I mean, this is all a moving target. But again, I want to reemphasize what I said earlier. Until we get the health crisis under control, we cannot expect the economy to get back to any sense of whatever that new normal is. So this means some of that's under our control, right? Some of it's our own social behavior, what we do, whether we're wearing a mask, whether we're following the guidelines. And some of it, of course, is the advances in medicine and science. But we can't just bet on that alone. I mean, we really need to do collectively what we need to do to help bring the economy back. I'm really concerned about this, and people didn't bring this up, but one of the biggest impediments, I think, to economic growth going forward is the issue of childcare in schools. If people are fearful to send their child to school, in some cases for good reason, we're back to childcare. And we see this, right? Over half the childcare facilities in this country, many of which are run by small businesses, closed. And of the remaining, 85% of them cut their capacity in less than half. So this issue about how to safely, and I want to emphasize safely, get children back to school, because that's going to weigh on parents, understandably. If they don't think their child's safe, how are they going to be productive at work or even go to work? So I think that right now is right in front of us, how to do that. And if we can't do that, we shouldn't expect economic growth to take off anytime soon in a major way.
And then just a follow-up, I realize that, much of this information, much of the data that's coming in is completely out of your control, out of everyone's
Right.
control. Obviously, we would have liked that COVID to have been under control yesterday. Is there sort of a date that you would put out into the future that if it's not under control by, January 1, 2021 or another date, is there sort of like a doom date for you?
Yeah, that's difficult to say. I mean, again, given what we saw before this recent surge, we're looking at the economy. It wasn't going to fall off the cliff. It was going to get back, though, at the end of 2021. So it's going to take well over a year to start to get back, because there's been a lot of damage due to this crisis, and we know that. It's hard to make that prediction right now, given how quickly things are moving.
Thanks so much. I appreciate it.
Thank you. Thank you.
Ben, can I squeeze one in?
Please,
Ben?
Yes,
Yeah.
Ben, go ahead.
Hi, Pat, John Finley.
Hey, John. Be safe in the
I
car,
miss-
John.
Yeah. Well, I miss you at the Planet Fitness too. So
Yeah,
hopefully
we
we'll
don't
get
have our
back to some
gyms.
normal. Pat, more personal, when you took this job, you certainly didn't see this pandemic as a
No.
a major curveball. How has this changed the way you have looked at everything? And the Fed is doing a terrific job, but I'm just curious from a personal standpoint.
Yeah. So when I took this job, we were still in the tail end of the financial crisis, but at least we saw there was we could start to lift off and we could start to recover from that, which we did over time. This one just really hit us all. I mean, everybody, like a ton of bricks. And so, and people all across the economy are working incredibly hard. I mean, people are just doing what they need to do to help bring the economy and this country back. And so you see it all over, whether it's the essential workers or everybody. It's just one of these periods of time where you didn't expect it. Nobody expected it. But what I'm really proud of is working with my colleagues, because we're doing whatever we need to do within our mandate of what we can do legally to help the economy. But we see this all across the economy. And people are doing some heroic work in this economy, and you just got to give them credit.
Yeah. Thanks, Pat. Great answer. Thank you.
So Dan, did you want to say a few words?
Well, hey, no, sure, Ben, I appreciate that. From the Citizens Bank perspective, this is why we're so proud to be sponsoring this Center City Proprietors speaker series, because of the quality of the speakers that we have. So, great thanks to a good leader and friend in Pat Harker. And, from a banker's perspective, the Fed has done really a terrific job, because what the Fed did, they got ahead of this crisis. They could see the severity of it, provided a lot of liquidity. And the big thing they did is they made sure that they had the backs of the banks, so that the banks could provide the forbearance on mortgages and auto loans and other loans to small businesses to weather the storm on liquidity. So again, that's where the Fed was really terrific, getting out in front. But from a regional perspective, we're just really fortunate that Pat Harker is the president of the Philly Fed, because again, you see the dynamic leader that Pat is, and again, his great experience both between academia, corporate leadership, as well as government leadership. And you can see that academia is, Pat gave a really terrific monetary policy tutorial that was very hard. Pat, you did in 3 minutes, which usually takes a full semester in undergrad, right? On how the Fed manages the money supply, but really is terrific. And what the big thing that Pat emphasized, we're really fortunate as a region. And again, so, from Citizens Bank, we just love these series. Again, we've got the most branches in the city of Philadelphia. We have the most low to moderate income census tract branches in the city. So we live in the neighborhoods of Philadelphia. And that's why workforce development is such a passion for us, because that is the connection. And again, Pat Harker's leadership at the Philly Fed, they're a real important partner for me as vice chair of the Philly Works Board. So we're just really fortunate to have such a hands-on, dynamic Fed president for our region on so many fronts. So again, it's just been a terrific dialogue here today. I appreciate what the Center City Proprietors Association is doing, gathering important businesses, small businesses together on really critical issues. So again, this has just been a terrific session. And so again, on behalf of Citizens Bank, we're just happy to continue to support this speaker series. It's really, really important work. And again, the other big thing that we have, right, and we talked about, you have hospitality and restaurant issues coming up, obviously extremely hard hit. But the other big issue that I was literally talking about earlier today was it is about minority entrepreneurship and getting the seed equity capital there. Charmaine asked a question around home ownership, building equity. But it's also the CDFIs, as Pat said, that's our gateway for banks. All of us as banks, we partner with CDFIs, but they've got to be that barometer of how we get to measure, but also the instrument to how we get seed equity capital. As everybody knows, when you're starting out, you can mortgage up your house, but loading up on a lot of debt as a startup isn't really the answer. It really is about having some equity capital. So that's what we're all working on from both a lobbying perspective of our federal legislators through state and local, making sure that we support those entities. But again, so much of that runs through what, the great entrepreneurs that are on this line and the membership of the Center City Proprietors Association. So Ben and team, thanks for all you're doing. Dave Leno, it really is a great session, and it's been great. And get all the best and stay healthy, right?
Thank you, Dan. And thanks, Pat. It was really good getting to know you and hearing everything. And just thanks again to all the sponsors. If anybody is interested in membership or any of the upcoming events, just email us, get in touch, and it's really good to see everybody.